Hello, this is Craig Larson with Larson Financial Advisors for the Market Minute on June 10th, 2014. Hope you're enjoying the beginning of your summer so far. Today, because there hasn't been any significant shifts in trends for a while, I thought I would talk about the paradox that we see developing in U.S. stocks. Number one, on the plus side for the U.S. stock market, it is still outranking on a trend basis all the other asset classes. And in fact, the fund scores that we see are just very, very robust, very positive right now. And we don't see any trend shift that's happened at all to change that. So we still are very bullish on stocks as of today. Now, the dark side of this paradox is the valuation side of it, which is, are stocks in general cheap or are they expensive? And think of this like a balance beam. If you're crossing a balance beam and it's 12 inches above the gym floor, there's just really not much risk of injury. You could fall off the thing and the worst that's going to happen is a bruise or two. If the balance beam is 3 feet above the floor, you may get more significant bruises, but it's definitely not going to change your lifestyle at all. Whereas if the balance beam is 20 or 25 feet above the gym floor and you fall off that balance beam, that can be life-changing and potentially deadly. So from a valuation standpoint now, how do you find out whether stocks are cheap or expensive? Well, typically you'd use some type of PE ratio, the price to earnings ratio of a stock. How much do you have to pay in the market to get a unit of earnings? And the Wall Street methodology for calculating that, we at Larson Advisors tend to be very skeptical of, because there's a lot of inherent conflict of interests on Wall Street, and typically they take current profits and earnings levels and forecast them out indefinitely. And right now we have almost record high earnings in stocks, and that's not likely to persist at that level. So I don't think those are reliable metrics. I tend to prefer a more academic-based measurement system. Some of you have probably heard of Robert Shiller, a professor out of Yale. We like his valuations. Ed Easterling at Crestmont Research is another one. Tobin's Q is a formula that we learned about years ago in college in investing classes. And even Warren Buffett's valuation method, which is to look at the Wilshire 5000 stock index versus GDP. Any of those metrics that you look at basically today point to a very overvalued U.S. stock market. And in fact, overvalued to the point where in the last 100 years it's only been a higher valuation level twice. Those two times, number one was the tech bubble back in 2000, and most of you watching the video will remember what happened to the general market, let alone tech stocks, after that peak. The second peak where valuations were higher than today was in 1929, just prior to the Great Depression. Now, I am in no way trying to make a forecast here, and we're not forecasting any kind of a crash or depression or anything like that. We're merely trying to say that from a risk standpoint, this balance beam is, about as high as it typically gets, and thus the risk of a higher fall is greater. So when we look at the options for investing right now, U.S. and international stocks are still in the first two positions. So this is still a growth world, and we don't know when that trend is going to reverse. Okay? But from a valuation standpoint, we can tell you that there's a high amount of embedded risk potentially in the market. So when it decides to go down, does it go down 10%? Does it go down 60%? We don't know, but the potential is there for a big one. For that reason, we will reiterate our recommendation that you have some type of a flexible and adaptive strategy to either exit holdings when the trend shifts, or to hedge your losses or limit your losses in some way, shape, or form, because a person can recover from a 10 or 15% loss relatively easily, but it's really difficult to recover from a 40, 50, or 60% loss in your portfolio. So if you have any questions about how to do that or what some potential strategies are, please email me or call, and I'd be glad to review your individual situation with you. Thanks for tuning in, and have a great week.